The webinar today is about how to avoid being double taxed as an expat. So we want to make sure that people are not paying double tax and give you information about how to avoid being taxed twice. So my name is Rebecca O'Malley. I've been a CPA since 2008, and my primary focus is on individual taxes as well as corporate and small business. And I've had over 16 years in accounting and tax, providing consulting, tax preparation, tax review. I also provide tax planning, consultation calls for TFX. And my focus is again on tax planning and preparation. So very experienced in these areas to help you avoid being double taxed. So our firm TFX has been in business for over 25 years. We have enrolled agents and CPAs around the world. We have 80 plus individuals working for our firm preparing taxes. Everyone that does your tax return is either a CPA or an enrolled agent. And then we also have teams of peer reviewers who are CPAs and enrolled agents doing secondary reviews on tax returns. And we filed over 40,000 tax returns. So we have experience in whatever situation you might be in. We have taxpayers that are behind in filing. They might be current, but maybe they didn't know they had to file their income from outside of the United States or report assets outside of the United States. So we help them file through amnesty programs or the streamlined procedures. So any situation that you might be in, I'm sure we have encountered it. So our agenda for today, we're going to talk about what is double taxation, what are some of the common ways that you as a taxpayer can avoid being double taxed in the United States and your resident country. What are some of the pitfalls or errors in claiming these exclusions or credits? We'll also talk about international Social Security contributions. So this is separate from income tax, but it's the Social Security taxes that you might pay to the United States and your local country. We'll also talk about retirement plans and child tax credits and how those are impacted by either the exclusions or credits that relieve double taxation. And we'll also talk about the upcoming filing deadline on June 15th. So what is double taxation? So double taxation means that you are subject to tax in the United States. Every citizen, green card holder, and US resident is subject to filing a tax return in the United States and reporting worldwide income, regardless of where you live. So someone might have been born overseas, they might never have stepped foot in the United States, but because you are a US citizen or green card holder, you still have to report all of your worldwide income. So for example, someone living in France as a resident would be required to report to France all of your worldwide income as well and be subject to tax on that income in France. And at the same time, you'd have to report that income and be subject to tax in the United States. So the US has entered into agreements with other countries. These are called tax treaties. And part of the tax treaties are to relieve double taxation or to provide for reduced rates of taxation on certain income. So it sounds simple, but each tax treaty is different. The income tax treaties for each country define income, and they define the terms and the articles of the treaties differently. So that's where our expertise comes into play. We deal with the tax treaties on a daily basis. So depending what country you live in, we would be able to look at the information you provide to us and determine what benefits you might be eligible for with the tax treaty. So the tax treaties, part of the tax treaties, there is something called a savings clause. So US citizens might not be eligible for many parts of the tax treaty because of this savings clause. The tax treaties tend to be more for the benefit of non-US citizens. But because of that, there are different ways to relieve double taxation. And so we'll talk about those common ways today, because those would be applicable for US citizens, green card holders. So the first common way to reduce your double taxation that we'll talk about right after this poll. So this poll, we want to see who is filed for 2021 tax year, who still needs to file, and if you're an existing client of ours or not. So if you wouldn't mind just taking a few minutes, fill out the poll, and then we'll move on to talking about the common ways to reduce double taxation. So these questions, again, we'll ask who still needs to file. We have extensions that we can file for you, which we'll also talk about in a few moments at the end of the presentation. So if you still need to file, the deadline is coming up, but we can certainly help you and either file timely or file an extension for you. So again, I'll give you a couple more minutes to answer the poll. Okay. So the first way to reduce double taxation, again, if the treaty, the treaty might not provide as much benefit to a US citizen or a green card holder. So there's certainly other ways to reduce double tax. So the first is the foreign earned income exclusion. This is a huge benefit to taxpayers. Each year, the IRS publishes a limit. It increases each year slightly for inflation. But taxpayers can exclude their earned income, which is income from performing services as an employee or a self-employed person. It's pay for compensation for performing services. So for 2021, if you meet the requirements of the foreign earned income exclusion, you can exclude up to $108,700 from being taxable. So you still have to file a tax return, but there's forms you can file with your tax return that make this money excluded from taxation. And for 2022, that number is increased to 112,000. So we would help you determine, is the foreign earned income exclusion most optimal for you, or are one of the other methods of reducing double taxation better for your particular situation? So usually the foreign earned income exclusion is most optimal for expats whose only income is earned income and their total income is below the threshold for the annual limit. It's also most beneficial for taxpayers who live in countries that have no income tax or that have an income tax lower than the US income tax. And you'll see that as we talk about the foreign tax credit. So if you don't have enough taxes paid to another country to offset the US tax, then the foreign earned income exclusion is really most beneficial for you. And we'll talk about this on some other slides as well, but again, determining whether it's optimal for you depends on many factors. So whether you contribute to retirement plans, if you have children, the way that the foreign earned income exclusion interacts with other credits and benefits, it could make some of them ineligible for you. So again, we would take all the information you provide to us and determine what is most optimal for you. And in some cases, the foreign earned income exclusion may not be most optimal. So we might revoke it or not use it in a year. Then you cannot use it again for 5 years. So again, we would discuss all this with you, tell you the pros and cons and what we think is most optimal for your situation. Related to the foreign earned income exclusion is the foreign housing exclusion. So if you qualify for the foreign earned income exclusion, then you can also qualify for the foreign housing exclusion. And this is for taxpayers who are living outside of the United States who pay housing costs like rent. So if you own your home, this would not apply to you. But if you're paying rental fees for your housing, including utilities, other costs to maintain your home, a rental home, then you can qualify for this. And this is actually another really big benefit to taxpayers. It provides an additional exclusion on top of the annual limit. So we said for 2021, the foreign earned income exclusion was 108,700. And you could qualify for a maximum exclusion with the foreign housing exclusion of $141,310 for 2021. So if you think about your income, you could have earned income from wages or self-employment and be able to exclude up to $141,300. So again, that's a huge benefit where you don't pay any US tax on that income. So we ask questions in our questionnaire about your living situation, how much rent you pay, and that helps us determine if you qualify for this. Each country that you live in has different limits for housing, like a maximum limit. So we're very familiar with those. And so we'll make sure that you get the maximum exclusion that you're eligible for. So the next question, we've been saying like if you qualify. So to determine whether you qualify, to determine whether you qualify, the IRS has a series of tests. So first you must meet what they call the tax home test. This doesn't mean where you actually have like your family home. It just means where you perform your work on a regular basis. So if you are regularly working outside of the United States, and that's your main area of employment, then you would be considered to have a tax home outside of the United States. And again, if you're outside of the United States in that tax home for a year, then that's considered your tax home in a foreign location. So you must have a foreign tax home, and then you must meet one of two tests. So you either have to be what's called a bona fide resident or meet a physical presence test. So I'll just talk about those briefly. So the physical presence test looks at a 365-day period. And if you're outside of the United States for at least 330 days in that period, then you would qualify for the foreign earned income exclusion. So for those of you moving outside of the United States mid-year or moving back to the United States mid-year, it doesn't have to be a calendar year period. We can look at an alternative period that overlaps into the calendar year. So you could still qualify for the exclusion. It would just be prorated. So again, in our questionnaire, we ask you for your US travel dates during the year or periods of years. And that again helps us to find the most optimal period so that you can get the most amount of the exclusion. Now, for individuals that have made their permanent home outside of the United States and they have no intention really to return to the United States in the indefinite future, then you might meet what's called the bona fide residence test. This means it's a very subjective test. It looks at different factors in your life, your intentions, and like if the actions support the intentions. If you qualify for this test, it's kind of saying that you have become a resident of another country and all of the centers of your life and vital interests are in that country. This does allow you to travel back to the United States more than 35 days, where the physical presence test is very cut and dry with the number of days. So again, you can qualify for the foreign earned income exclusion with either of those tests. So it's important to provide us as much information in the questionnaire about your situation so we can best determine what applies for you and that you qualify. So for individuals that either don't qualify for the foreign earned income exclusion, or if it's determined that perhaps the foreign earned income exclusion is not most optimal for you because you want to make retirement contributions or you have children and would qualify for other credits, then there is something called the foreign tax credit, which would again relieve double taxation. So currently with the foreign tax credit, you can get a credit in the United States to offset the US income tax with taxes that you've paid to your resident country. So these would be income taxes that you pay to another country on the same income that is taxed by the United States. So real estate taxes that you pay or personal property taxes, those would not qualify. It has to be an income tax. So there is a form, there's a picture of the form that's filed on this page. It's form 1116. So this is something that we would take care of for you. The form itself is complex, involves many calculations. There's different categories of income, and we would look at your taxes and your income from whatever country you live in and determine the eligible foreign tax credit for each category of income. So for example, you pay tax on your wages, and let's say you have income from selling stocks and you have dividend income. The taxes paid on wages can't be used to offset the taxes of the dividends and capital gains. Those are two separate categories. So again, we are very familiar with all of these forms, the credit, how the taxes are calculated. So we would get the information from you, do all of the calculations, and ensure that you're getting credit for the taxes that you've paid. So can you deduct all taxes that you paid, for example, to France in the United States? So again, as I mentioned, using this credit is complex. There's different categories of income. Each country has different types of taxes, And so you have to understand whether a tax qualifies as an income tax and to what category of income it applies. So for example, in 2019, the US and France came to an agreement that French CSG and CRDS taxes previously were considered like Social Security type taxes, not eligible for the foreign tax credit. In that year, they did come to an agreement that it now qualifies for income tax credit and qualifies as income tax. So these are just the kinds of things we keep abreast of, the changes in how the US views different types of taxes, and make sure that you claim all the eligible taxes that you've paid. Some additional complexities of the foreign tax credit. For example, in Islamic countries, there's a tax called the zakat. So these taxes, we'd have to determine whether they qualify as income tax, whether you can add them. In Germany, there's a solidarity tax. So different countries have different types of taxes. And again, we'll find the ones that are qualified and claim them for credit. In addition, in some countries, if your employer contributes to a retirement plan, then you do have to include that in your earned income and your tax on those employer contributions. However, because of the tax treaties, certain countries you do not. Like for the UK, for example, there's a very tax-friendly treaty, and employer contributions are not required to be included in income. So sometimes it's beneficial to include them, depending on your situation. Sometimes it's not, and can lead to higher taxes. So these are all the types of optimizations that we would perform with your return. If you live in a country that has higher taxes than the United States, for example, the UK generally, many of the European countries have in general higher income taxes than the United States. So when claiming the foreign tax credit, you can actually carry forward extra tax that you've paid to your local country for up to 10 years. So you can then use that as a credit in future years. So if you're claiming the foreign earned income exclusion, you may lose out on those credits that can carry forward. So we look at all of that together to optimize your return. So even if you understand the terms and you've kind of read through the form instructions, it can still get confusing. And so, that's where having an expert in the field can be helpful. So, for example, retirement contribution. So if you're someone who's benefiting, you're contributing to retirement accounts like an IRA or a Roth IRA, these are valuable savings tools, and they allow for sometimes tax-free growth if it's a Roth account, tax-free distributions upon retiring. So depending what types of methods you use to reduce your double tax, whether it's the foreign earned income exclusion or the foreign tax credit, you might sometimes be ineligible to contribute to a Roth or to an IRA account. So if you're using the foreign earned income exclusion, for example, you might be excluding all of your earned income from being taxable. And one requirement to contribute to a Roth IRA or traditional IRA is that you have earned income. So in that case, it might be more beneficial for you to claim the foreign tax credit, or there might be some other strategies where we can use an alternative 365-day period to exclude part of your income, leaving some taxable. So again, which credits and exclusions to utilize, determining what is most optimal. Something that might be right for one person might not be right for another person. So for example, you can combine certain credits, but some of them are not allowed, which we talked about. Like if you are claiming the foreign earned income exclusion, you might be ineligible for some of the refundable child tax credits. So someone with kids would probably benefit from using the foreign tax credit. Someone without kids benefit from using the foreign earned income exclusion. So the IRS tax code, I don't know if many of you have ever looked at it. It's 10 million plus words long. It's if you do this, then you can do this, or if you don't do this, you might not be eligible for this. So there's very complex nuances in the tax code, and we're experts in that area. We work with the tax code on a daily basis, so that's something that we're very into the details and understanding how it would apply. So, there's many people that self-prepare or work with companies that are not experienced. And sometimes they might make they might not make certain adjustments that are needed. And you could have the foreign tax credit overstated, or some of the income might be not stated properly. That can later lead to IRS scrutiny. So just better to work with an expert upfront. As some of you, you might be experts in engineering or architecture. If we were to go into that field, that's not something we would be an expert in. So we are experts in this area and can help you. So I mentioned in the beginning that there are tax treaties. These are each unique. They define income differently. They have rules of which benefits are available to whom. And like I said before, they do have savings clauses where many of the benefits, we have clients all the time who refer to the tax treaties and think that they might be eligible for, all of these benefits, but they don't realize that a lot of the tax treaties contain clauses to make US citizens and residents ineligible for many of the benefits. And these vary country to country. So we are working with these every day, and we can answer any questions that you may have, as well as analyze your situation and take advantage of any parts of the tax treaty that do apply to you. Then there's also other factors to consider. So not everyone that we work with is a US citizen or resident. We might have, some of you might be visa holders living in the United States. So we can determine whether you qualify for certain exemptions from taxation in the United States, whether you're eligible to be a bona fide resident for the foreign earned income exclusion, and whether tax treaty benefits do apply to you. So again, each visa type is treated differently for tax purposes. In addition, we have many taxpayers who are service members. So there's certain parts of the tax code that apply differently to service members. So there's some different limits and rules regarding the foreign earned income exclusion and whether you might qualify. Another factor to consider is your local country citizenship and residence, which again can impact whether you qualify for certain treaty benefits, whether you meet the bona fide residence test. And if you're a non-US citizen, but you're still required to file a tax return for having US sourced income, you may be eligible for more treaty benefits and be able to have all or some of your income excluded from taxation or taxed at reduced rates. So next we'll talk about Social Security contributions. And again, if you have any questions, I know we're going through a lot of information, you can please just submit your questions to the Q&A and we'll have our team answer them. And at the end, we'll have some live Q&A. So for Social Security contributions, so again, in addition to income tax, each country has a Social Security tax you pay into. In the US, it's pretty straightforward. If you work for a US employer, your employer will withhold Social Security tax and pay the employer portion. If you are living outside of the United States and living in another country, you may pay into the Social Security system of that local country. Especially if you have an employer in that local country, then they would be withholding your Social Security taxes. So in some cases, you may be paying into both systems, but you might be eligible for Social Security taxes that are paid to another country to be a credit in the United States, or you might be eligible under a totalization agreement to be exempt from Social Security taxes in the United States. Another thing related to Social Security, some people are concerned about if they've kind of split their career between the United States and another country, how will that impact their benefits at retirement? So the United States does have agreements, which we'll talk about in a moment, with other countries, with 29 other countries. And in those agreements, they talk about transferring credits from one system to another at retirement. So if you have questions about how your local country credits would interact with your US credits, we can certainly answer those questions as well. So these agreements I referred to are called totalization agreements. So they are not the same thing as a tax treaty. The United States does have more tax treaties than it has totalization agreements. And these agreements only cover Social Security and like welfare, Medicare benefits. So they coordinate the US system with a comparable program of other countries to fill gaps where there might be missing protection for taxpayers. So as employees, you generally pay into the Social Security system of the foreign country if you have a foreign employer. And as a self-employed person, however, there is more complexity. And so there might be nuances. And so we'd refer to the totalization agreement, if there is one, to see how you would be taxed. So for example, in Italy is one that's a bit unique. So in Italy, if you are working for a US employer, or if you're self-employed, the way that you pay into Social Security depends on your nationality. So if you're an Italian national, for example, if you work for a US company or you're self-employed, then you can choose whether to contribute to the Italian Social Security system or the US system. But for the similar person who's working for a US company or self-employed but is a US national, you're required to pay into the US Social Security. So again, similar to tax treaties, totalization agreements are all different, and the way they apply to you is based on different factors: your nationality, how long you would be employed outside of the United States in another country, your type of employment, the location of your employer. So we would make sure when we're preparing your taxes that we're taking all those factors into account and making sure that you're only paying into one system, not both. And if you have questions on any of these, we do have tax planning consultations that we do. We can answer questions specific to your situation. So every return that we prepare, we make sure that we optimize it. We have certain procedures that we perform, credits, deductions that we look at for every return and determine which one is optimal for you. So as I've mentioned in a few places in this presentation, the child tax credit. So for individuals with children, for minor children, this can be a huge tax benefit. Not only is there a child tax credit, but there's something called the additional child tax credit. And the additional child tax credit is actually a refundable credit. So depending on your income threshold, if you're under the certain threshold, you can qualify for the refundable child tax credit. So someone who doesn't pay any tax or have any tax withheld in the United States, but has one or more children who are minors, can actually receive a refund each year, up to $1,400 per child. So that can be, that can also be a huge benefit. So that is not applicable for someone claiming the foreign earned income exclusion. That child tax credit that's refundable is not available for those individuals. So again, we would look at your situation and see if that is most optimal for you to forego the foreign earned income exclusion and rather claim another method of reducing your tax in order to get these credits. So we do have an upcoming filing deadline, as I mentioned. So for taxpayers outside of the United States, if you are outside of the United States on April 18th of this year, which was the general filing deadline, then you had an automatic 2-month extension to June 15th to file your taxes and to make payment of your tax due. Certainly, it can sometimes be hard to gather documents or just get everything together. So if you do need an extension, we can file one for you. So you can actually log into your client portal. The slide will, it'll show you it's pretty easy to request an extension. And by requesting an extension, you can extend your filing date to October 17th of this year. There's really no downside to filing an extension. There's no additional fees to file the extension. There's no penalties to file the extension. It just gives you more time to make sure that your tax return is accurate. And it literally takes, 1 minute. You would go into your account, request that we file an extension for you. We just require a retainer of $50, and that would be used towards the tax preparation fee. And just a reminder, so it's an extension of time to file your tax return to October 17th, but not an extension of time to pay. So if you think you may owe any tax, that is still due by June 15th. And so if you have questions about, how much you might pay by June 15th, we could certainly do a tax planning consultation, or we can do a tax projection if needed, to give you an idea of any tax that you may owe. So our firm, as I said in the beginning, we are extremely experienced in this area. We work with taxpayers from around the globe, as well as individuals in the United States. So you do not just have to be an expat to work with us. We have clients in the US who have, no income from outside the US. They just enjoy working with us. They appreciate our expertise. And so we've been working with clients within and without the United States. And as discussed in this presentation, there's a lot of factors that go into optimizing your return and understanding how the tax code interacts. And so we do this for every tax return. We make sure that it's optimized, and again, it's prepared by CPAs and enrolled agents, and also undergoes a peer review. So I would say, recommendations is provide us as much information as you can in the tax questionnaire to ensure that we have all of your information and are able to optimize your return. So another benefit that we offer to our clients, so we have money that we want to spend on marketing. We would much rather put our marketing dollars back in your pocket and have word of mouth marketing. So for our clients that are happy with our service, we do offer you a $25 credit for referring friends, family, anyone that you think would benefit from our service. So you can refer one friend, you could refer 5 friends, and you get a $25 credit for every client that you recommend that uses our service. So there's no limit on the number of clients that you can recommend to us. And your friend would also receive a $25 credit. So you each would receive a $25 credit. So we are going to move forward. We will have a poll shortly and the Q&A. So again, look for an email from us that has the Q&A questions and answers, as well as a recording of today's webinar. So there's going to be a last poll before the Q&A. And this just asks, how did you learn about our webinar today? And do you have topics that you would like us to discuss in future webinars? Okay, so just looking through some of the questions that have come through. Okay, so one says, are there 2 ways to file taxes for Americans living and working and paying taxes in Australia, by way of the tax treaty or without? So living and working in Australia, you would still file a tax return in Australia. You would generally pay income taxes to Australia if your income is from Australia, you're working in Australia. And on your US tax return, again, if you're a US citizen, many of the treaty benefits might not apply. So using what we had spoke about today, the foreign earned income exclusion or the foreign tax credit would be your primary methods for reducing double taxation. And again, there could be some treaty benefits that do apply, but usually for US citizens and residents, those are limited. So again, we would look at all of your income, the types of income you have, the types of taxes that you pay, and determine what way is most beneficial for you. So another question, it says, it was stated that the self-employed person must pay into US Social Security. Does the other country always agree with that? What if we are currently paying Social Security in the foreign country? So for this one, it depends what country you live in. If it's one of the countries that the US has a totalization agreement with, then per that agreement, it specifically specifies, again, based on the different factors, how long you're employed, if your employer is US or foreign, if you're self-employed. So this question was about self-employed. So if you're self-employed, the totalization agreement will say whether you're covered by the US system or the local country. And so you can get what is called a certificate of coverage to kind of prove. So you said, did the other country always agree with that? So if you're paying into the US Social Security system, and that is in alignment with the totalization agreement, you can get a certificate of coverage to provide to your to the foreign country to prove that you're covered under the US system, or vice versa. So to answer whether they would agree with that, yes, if it's in accordance with the totalization agreement, you can get a certificate of coverage to prove so that you're not paying into both systems. So someone had asked, they said, I need assistance. How can I make an appointment with one of your advisors? So I think someone from our team is actually writing back to your question right now. But in general, if you wanted to speak with someone on the phone, you would log into your client portal and you can request a tax planning consultation. And this would be a 30-minute phone call. You would send us your questions ahead of time and we would go in detail through all of your questions. Someone else said, I am a dual US New Zealand citizen, permanent resident of Australia. Which superannuation contributions are reportable for income tax, FBAR, and FATCA? So this would be a question that we would address with you during tax preparation. We are familiar with those retirement systems, which contributions are taxable, but in general, your employer contributions that are made into your account are taxable. And in general, those accounts are all reportable for FATCA and FBAR. But again, we would work with you on your individual situation and let you know which ones are required to be reported and which income is required to be reported. So someone had asked, do we provide Schedule B of Form 1116 to carry forward tax credits? So yeah, we would look at any prior returns that you filed to see what tax credits you have and ensure that those all get carried forward. How can we get in touch with you? So you can go on, log into you can create a client account and you would be assigned a CPA or enrolled agent. You can email your assigned preparer. We also have an email, info@taxesforexpats.com. If you log on to our website, www.taxesforexpats.com, there's information there on how to reach out to us. So someone asked, do we handle complex returns that include rental income, Schedule K on real estate, itemized returns, in addition to being dual resident and working for like a California-based company, having investments, IRA accounts. So yes, we do have experience in all of those areas. We do handle very complex returns. Many of our clients have both investments, real estate in the United States, as well as outside the United States. Many of our clients are owners of non-US companies. And I'd say a significant portion of our clients also have investments or cryptocurrency, IRA accounts, foreign pension accounts. So we are experienced in many different areas. Someone else asked about rescinding US citizenship and living abroad forever. Will you still be eligible for Social Security that you've accumulated in the US? So this depends. So in general, yes, but it depends what country you live in. There's certain countries where the US will not allow payments to be made, or in some cases, there's requirements that you must travel back to the United States for certain periods of time. But again, we would talk to you about what country you live in and let you know how that applies to you. We also work with clients that do give up citizenship and help them through that process, as well as clients that are abandoning their green card to make sure that they comply with all the tax obligations to not be subject to US tax any longer. Someone asked, they filed a foreign earned income exclusion. Do vacation days in the US impact their number of days for the 330 out of 365 days? So yes, any travel days to the United States do count as days for the foreign earned income exclusion. But you should keep track of your working days separate from vacation days because that does impact how your income is split. But yes, for being eligible for the foreign earned income exclusion under the physical presence test, you would look at all days in the United States. Again, with the bona fide residence test, you are allowed to be in the United States for more than 35 days. as well as as long as you qualify for the other factors with the bona fide residence test. Okay, so I think we've gone up through most of the questions. There's still a large number of questions. Our team is still answering some of those questions. So we will send out, again, we'll send out a text transcript of the questions. But if you have any questions that were still unanswered, feel free to reach out to us. Someone said they would like to know more about capital gains tax. So yeah, these are all questions that we can talk with you individually about your specific situation. Because again, there are general answers that we can give, but each person's situation is unique. So the best option is to contact us either for a tax planning consultation, or if we start working with you on your tax return, we'll go through all of your income and your assets and let you know, how they should be reported and if we need additional information. But again, we'll optimize your return so that you're paying the least amount of tax and definitely not double taxed. So thank you all again for participating today in the webinar. We'll take your ideas for future topics, and we will send out, the next time we have a webinar, we've been tending to do them once a month or more frequently. We will send out information on the topic for the next webinar, and we hope you can join us again at that time.